So welcome you all once again to the third section of the today's section. This is the last meeting for the evening, so we have to do more. Okay, so we've looked at the intangible asset with and without definite life. Let's move on to the second section. So internally generated intangible assets. That's where we reach. So let's take note. We've looked at how we treat intangible assets with definite life and none without definite life. Now we are looking at internally generated intangible assets. How do you treat them? Now, when it says internally generated intangible assets, it can be software created by the company itself. Here we are saying that self-constructed asset. Self what? Constructed asset. So self-constructed asset or self-manufactured assets. So for instance, the IT department and the account, they have teamed up to generate an accounting software called Cash Master. So how do you treat such software? Now, there's one issue that we have with the intangible asset. You know, before you can record intangible assets, the two conditions must be there. The recognition measurement, recognition talks about the conditions. So first, it must be probable that future economic benefit will flow to the entity. Good, before you can record it. The last condition, the cost of that intangible can be measured reliably. Now what happened is this, internally generated intangible that the company generated by themselves. How do you treat it? Usually, the challenge is that the cost of such intangible cannot be determined reasonably. Why? The reason is this. We cannot separate the cost of that internally generated intangible from the company's own cost, the company's own normal cost. So if the IT department joined the account department to create an accounting software for the organization, then the issue is that we cannot, sometimes may not be able to determine the cost of this software accurately. Accurate in a sense that you cannot even separate it. You cannot separate it from where? From the organization's normal cost. We cannot separate it from the organization's normal cost. So as a result of that, we are saying we don't need to record it. So if you can determine the actual cost that went into the software generation or the software creation or the internally generated asset, do not record it in the book. So here, if the cost cannot be determined, do not record it. So do not record or recognize. So do not recognize if the cost cannot be determined or the cost cannot be separated. Do not record it. That's all. You only record self-constructed. We only record self-constructed assets if you can determine the cost reasonably, then you can record it in the books. So self-constructed assets that you cannot separate the cost. So it must not be recorded as what? Intangible asset. Good. So that is it. So now we are done with internally generated intangible asset. Yeah, we are not saying specifically that or straightforward that or fixed that we don't record internally generated intangible. No, we are saying that Most often, most most of them, you cannot separate the cost from that of the normal overheads. So as a result of that, we should not record it in the books. So basically, that is it. So any internally generated intangible, not even that one, self-constructed asset that you cannot separate the costs, you should not record it in the books. And that is it. Now let's move on to research and development cost. Research and development cost. Now research and development cost. Here, these two items or these two costs have a different accounting treatment. These two have a different accounting treatment. First, the research cost must be expensed. The research cost must be expensed in a period that you incur them. So research costs, you have to expense them in a period that you incur. So let's see. Research cost must be expensed in a period that you incur them. So all research costs must be what? Expense. So here, research costs, all research costs must be expense. All research costs must be what? Expense in a P&L. That's the treatment. So basically, let us expense this one. That means it must be treated in operating costs as operating costs. Now, development costs eligible or qualify or met the recognition criteria must be treated as what? Assets or must be capitalized. So capitalize it. So two different things altogether. So expenditure and capitalization, expenses and assets. So that is it. So here we are saying that development costs that comply or meet the recognition criteria must be what? Capitalized. Capitalized means it must appear on the balance sheet. It must be treated as what? Assets and therefore reported on the balance sheet. That's the meaning of what? The capitalization. Good. That's the meaning of the capitalization. Now, before you can capitalize the development costs, you must meet certain recognition criteria. We call it pirates. Good. That it must be probable that the future economic benefits will flow to the entity. Then the intentions, that's the I, intentions to finish the assets. Good. Intentions to finish the asset or to complete the asset. Good. So all these conditions has been stated in this particular material that you have. Has been stated in nicely. So can go in further to read it. Okay, so now note we are down the intangible. Aside this, the normal one that we know, recognition, how do you record intangible? So recognition criteria. That's one thing that we have to look out for. Two, measurement. So these are the same as what? IS 16. So we don't need to talk about it plenty. Recognition and measurement of intangible assets are basically the same as what we did on IS 16. It must be recorded as what? Non-current assets. If two conditions are there. One, probable that future economic benefits will flow to the entity. Two, the cost involved can be measured what? Reliably. Then that is it. The measurement, we have the initial measurement is at cost. Subsequent measurement. Subsequent measurement of intangible assets, you select either the cost model or the fair value model. Yes, we use revaluation model for that of intangible assets. Intangible assets can be revalued. Yes, you can revalue your intangible assets. Then you are done. Okay. Okay. So basically, that is the game. So yeah, that with I statistics. Now let's face the question that we have here. So we look at it carefully. So we go through the questions in here to complete the game. So let's see. So we are going to look at all this and then look at them carefully. The following information related to Samampa Limited for the year ended 30th June 2020. During the year, the Information Technology and the Account Department of Samampa Limited developed an accounting software called Cash Master. So this one will be a clear example of what internally generated intangible or self-constructed asset, which will be used by the company to handle all receipts and payments. All the resources used in generating the software are owned by the company and therefore forms part of the general overheads. Samapa, okay, good. So let's do that one first before coming to the next one. So here it just internally generated what intangible. So here it will be very difficult for Samampa to what separate the cost of the cash master from that of their general overheads, their operating cost. If you cannot separate the cost of the internally generated software or the intangible, then we should not what record it as an asset. We should not record it as what assets. So here, no asset should be recorded in the books as what cash master. No. Why? Because the cost cannot be recorded what cannot be measured reliably, or the cost cannot be separated from the general overheads of the company. That is all we need to tell Samampa. That look, if you cannot separate the cost, and here is a they have given us a clear indication where we cannot separate. Say all the resources used in generating the software are owned. So they use the computers of the company, they use electricity of the company, they use, in fact, facility of the company, everything. So it will be very difficult to separate the actual cost of the software from the company's overhead. So we are done with that one. Let's go to note 3, note 2. Samampa Limited acquired a transport company during the year. An amount of 50 million was paid for goodwill. The account officer is considering amortizing the goodwill at a rate of 5% using straight line method. The recoverable amount of the goodwill is assessed to be 48 million. Now, goodwill, what's the example of goodwill? Which of the classification does it belong to? Goodwill belong to intangible assets that do not have a definite life. So intangible assets that do not have what? A definite life. How do you treat it in the book? One, we are saying that we don't what? Amortize them. However, we test for impairment annually. So here the account officer is considering amortizing the goodwill. So therefore, because goodwill is an intangible asset, it should not be what? Amortized. But instead, it must be tested for impairment annually. So let's test for impairment. Now you're saying that the recoverable amount of the good was assessed to be what? 48 million. So therefore, it means that we can test for impairment. So 50 million as the current amount here, and 48 million as what? As the recoverable amount. So therefore, this goodwill of Samampa has what? Been impaired by 2 million. So they have to record impairment of 2 million. So that's what we will tell them. So, so that first, intangible assets without a definite life should not be amortized. However, we have to test for impairment annually. A clear example is goodwill. So therefore, all what we have to tell the examiner is that You have to test for impairment. So let's see impairment. So the impairment will be first, you start with the carrying amount of the goodwill. Now the carrying amount of the goodwill will be 50 million. And then the recoverable amount is 48 million. So goodwill will be what? 2 million. Sorry, the impairment. So impairment has to do with what? 2 million. That's what you have to tell Samantha. That this accounting treatment, number one, add it to your operating cost. So that year they should add 2 million towards the operating cost. So add it to the operating cost. Number two, subtract it from the carrying amount of the assets. Subtract from the carrying amount of the assets. So therefore, now the new carrying amount will be 48. So the old carrying amount of 50 minus the 2, making 48, which brings us back to the recoverable amount. That's all for that particular question. Now let's move on to the next one. So still at Samampa, the DIII, the third one. So let's see that one too. That one stated that Samampa Limited commenced a research and development project on January 2020. It spent 1 million per month until 31st March. So he spelled 1 million. So if you're hunting for marks, he spent 1 million per month for 31st March. So he started from January. So 1 million, 31st March. That's 3 months, right? Good. So that will be 1 by 3 if I should end here. Then at this date, the project passed into development stage. From this date, it spent 1.6 million per month until the end of the year, 30th June. At this, the development was completed, yes. However, until 1st May 2020, the directors of Samampa Limited were confident that the product will be commercial success or meet its commercial success. All the costs incurred are included in administrative expenses. Now let's go to the board to do the illustration. This is what we are talking about. This is what happened. This is what happened. Now with the research and development costs, even though mostly they are together, the entry stage of development costs is the research. So they started some research. So let's go to the normal line. They started from January and then through to February until March. They incur 1 million per month. So at the end of 30th or the 31st March, the research stage was moved. So this is a research. Now the research include what? The research stage, feasibility studies, analysis, survey, and then market analysis. These are the research stage. Then they say after 31st March, the project passed into what? Development. Now after the research, after you've analyzed the market to see whether the product or the app project will be good, now you go ahead and start the development. Okay, there must be this buying of materials, put materials together, and then the first samples. So they said that then it passed. So that means April. So April May, and then June. April, May, June. Then that's what development cost. And they spent 1.6 million per month for development costs until June when they are done. But there was a note right after that comment until June where the development cost was completed. That note says this. They say until 1st May. Until what? 1st May. The directors were confident that the product would be a commercial success or will meet its commercial success. So that means until May, they were not sure whether the product will be good. So it means that, yeah, until May, we're not sure or ability to complete was not there. So that month on, we cannot capitalize it. It must be part of what? The research. So that month on must be part of what? The research. So it means that if I should end here and calculate the research cost, I tell the examiner that the research cost will be like this. Research cost, number one, the first 3 months. So the first 3 months by 1 million, that will give us 3 million. Okay, in fact, let me do it somewhere here where you can see it. I think that's right, it's not coming clear now. Okay, so let me do it here. So first, you get a research. I'll realign this on the it. You say 3 months at what? 1 million. That'll give us 3 million. Then April on is 1.6 million. So therefore that will be 4.6 million. So tell us that the research cost must be 4.6. Why? Because April we were not too sure. So that condition has not been satisfied. We are not sure whether the product will be good. Now, before you capitalize, one, you have to be sure, make sure that the product will meet its commercial success. Parade. So we have the intention. So these are the recognition criteria. So parade. Good. So before you record or you capitalize development cost, make sure that all these 6 conditions are in here. Make sure that all these 6 conditions are in here. So that is it. So first, it must be probable that this development costs or this product that we are developing, it will generate future economic benefits. Probable that future community will flow. Good. Now, intention. We should have intention to complete the assets for its intended use or intended sales. Good. And then resources. Resources availability. Resources. We should have enough resources to complete. Not that today we are doing research or development, and the next day we don't have resources to complete it. No. Then ability. Yes. Talks about the capacity. Your capacity to run it. Then T, technical feasible. Looking at our resources now, looking at our strategy now, our current situation now, is it technical feasible for us to run that program? Yes. So if you don't have apparatus, then technically it's not feasible. Then the last one is expenditure. So that's why the April on we did not what capitalize it with expense equal. So therefore, the development cost will be, it's only May and June that must be what capitalized as development cost. So let's see. So I'll do that one here, development. That one just 2 months. So that would be times 1.6. That would be 3.2 million. So we are done with this question. Now the issue is this. They said they have what added it to that of the admin expenses. All the amount total. That means we have to go and then this one is correct for them to add it to what? But this one must be 4.82 or 4.6. Yes, 4.6. Now it means that this one they have added it to what? The admin expenses, which is correct. So they've done it. So let's mark them. They've done it correct. By this figure, the development cost, it has been added to that of the, it has been added to the admin, which is wrong. Development cost we said must be what? Capitalized. This ones meet the conditions. You have to capitalize it. How do you do the capitalization? You have to add it to intangible assets. So here, treatment number one, subtract 3.2 from where? Admin. Because they've wrongly added 3.2 to admin. Good. And this is the same as what happened in suffer to gain and success limited. So success and suffer to gain, they have the same footnote in there. Good. Then two, subtract from administrative expenses because that's where they've added it wrongly. So subtract from admin expenses. Subtract from admin expenses. Subtract from admin expenses. Let me put here admin. Then two, add it to non-current assets. Then it ends there. Add it to non-current assets. So you add it to non-current assets. You add it to non-current assets. Then it ends there. You add it to the non-current assets. Then it ends there. Okay. So we are done with this particular question. Let's look at the last one on the list. Then we scan through some few past questions to see. Okay, so that means that's the last one. Okay, so the second one is the same as what you've done. So I'll leave that one for you. And let me go to last things past question. So let's look at last things own. Let's look at last things own. Last things own is on page I think 12 or so. After the solution, in fact, what you read, first three questions, all of them have solution. So immediately after the solution, another set continue. The first three questions, all of them have four. So this is it. This is the next set. Ababio. So question number two. This is last things set of the standards. Ababio. Ababio. Good. So let's look at that one. For this one, I'll not touch Ababio because it's the same question. So Ababio, we just come through. So here, let's go and read the requirement. The requirement is still the same. You are required to detail out the treatment of the above transactions in the financial statement of Ababio Limited for the financial year 2019 in accordance with the relevant IFRS 20 marks. Okay, so what we do here is the cost of plant 350 million. So that's the listed price. This 350 million, how do you treat it? So here, tell us the accounting treatment. Don't just calculate the cost for us. So that means every figure there must be explained where to treat it. Every figure there, we have to explain it. Not just calculating the cost and leave it. No. They didn't ask us to just calculate the cost. We said we should detail out the accounting treatment of the items above. So first, on 1st January 2019, ABBO Limited acquired a plant with a list price of what? 350 million. The following further costs were incurred. So this one, it will be part of, uh, this will be part of the cost, right? Okay, this will be part of the cost. Great. Now there's the question normally is moved from here. So let's look at this particular question. Good. Now let's come back to our question. So delivery. So delivery will be part, installation, general admin, and then initial operating losses will not be part. General admin will also be part. Staff training costs will not also be part. Dismantling cost, yes, it will be part, but you find the present value after 4 years. Cost of capital is what? 10%. Then you add them. Okay, so basically that is it. Now let's quickly look at these two questions and then you will try many ones for me. So the A is basically the same as this. And if you move further on the next page, it contained October 2019. And the same thing was also repeated. The first part, Arjunjene, was there. This is October 2019 question. What do we see now? So let's go back to our own. So let's look at the B part and see how best we can look at the B part. So first, ABBO Limited adopt revaluation model for subsequent measurement of its intangible assets. A software package with an estimated useful life of what? 5 years was acquired on 1st January 2018 for 48 million. It was revalued to this. So let's start line by line as usual. So a software package with estimated life of 5 years was acquired on 1st January 2018 at the cost of what? 48 million. So first, let's calculate the depreciation per year. So step by step. So depreciation, by just that we will call it what? Amortization. So we have to amortize the software. Why? Because it has a useful life 5 years. So first, quickly, let us examine that amortization. So I start like this. Cost of the software. As usual, we're hunting for maximum. So cost of what? Software. All right, the 48 million here. So let's rate 3 those. 48,000. Useful life is 5 years. After the examiner, amortization is the 48,000 all divided by 5 years. That's the amortization. 48,000 divided by what? 5 years. That will be the amortization. So amortization will be 48,000 over 5. This is what we get, 48 over 5. That gives us 9,600. So depreciation is 9,600 for a year. Let's see the number of years so that we can get the accumulated depreciation. So far, from the information made available, this is what we can do. We can get the cost of the software, 48. We can get the useful life, 5 years. We can calculate amortization. Good. Then, let's see. It was revalued to 56,500 on 31st December 2018. So the same year, So just 1 year. So if it's 1 year, it means that the accumulated depreciation will be what? Will still be one. So when I take it off from the cost of the asset, to give me what you call carrying amount. So carrying amount. So you can write on top revaluation, gain or loss. So the carrying amount will be what? So 48,000 less 9,600, right? Good. So this one will give us if it will be 10, it will be 30 plus 1, 31, 39. So that will be 37,000. So 38,400. Perfect. Then we are probably going to end. So that's the current amount at the date of the revaluation. So we can now bring the revalued amount. So revalued amount. So with the revalued amount, then we will now find the revaluation gain or loss. So with the revalued amount, we can find revaluation gain or loss. So I realize that the current amount is 38,400. Now, in event where maybe 2 years later, then this accumulated depreciation will change, multiply by 2. We take it from the cost, we look at the current amount of this. I'll continue from the other side. Yes, where the word is a bit okay. So let's use this side. Okay. So let's find the revaluation gain or loss. Revaluation gain or loss. And that date. I'm continuing from here because yes, that's basic. So first, what you do is bring the revalued amount is in thousand. So let's go and pick the revalued amount from the question. The revalued amount from the question. It was revalued to 56,500. So 56,500. The revalued amount is 56,500. Good. Carrying amount at the date of valuation is what? We have 38,400. So there will be revaluation gain. The revaluation gain of so the revaluation gain will be this revaluation gain 18,100. We are done. What's the treatment? One, add it, they've added it to what? Added to OCI. And then they have added it to the current amount of the asset before they arrive at this. So that was the treatment. Now let's continue the game. The OCI is the other comprehensive income, and if also added to the current amount. That was the treatment that they did. So let's quickly look at this. So the next now on 31st December 2018, they've done that. And revaluation surplus was correctly recognized on that date. Good. So the revaluation surplus of 18,100 was correctly recognized in the book. So that's why we said that they have added it. We are not going to treat it for them. No, they have already done that. Then let's continue. As at 31st December 2019, the asset was revalued at 30 million. Again, so exactly 1 year later, they did revaluation again. and they had 30 million. So let's go to the board. So that one too, first, we should find a new depreciation, new carrying amount. So new depreciation continuation. So that depreciation 2019. So here you can start. As at 31st December 2019, first depreciation, which will be the new amount, which is 56,500 divided by 4. Why 56? After valuation, the asset owed details vanish from the book. After valuation, the asset owed details vanish from the book, especially the old value. So right after the last year's valuation, the asset value was transferred to be what? 56,005. Originally, the assets have 5 years. 1 year is gone, so left with what? 4 years. So the new depreciation will be what? The new value over the remaining life of the assets. Given us a value of, so 56,500 divided by 4 will give us something like, so 14,125 as a depreciation. So first, let's still find a carrying amount. So let's continue to find the carrying amount. So first, carrying amount will be in the brackets the 56,500 minus what? The 14,125. Good. So now we should know the treatment of this figure because that's the current year's depreciation. We are advising them how to treat the issues in 2019, not 2018. That's why here they have already done it. Here we are not advising them to add. No, they've done it. And even the examiner informs us that they have correctly accounted for it or recognized in the books. The one that they are expecting us to do is December 2019, and that's the year in question. Good. So that is it. Then after find the carrying amount, we go ahead and use it to calculate what the revaluation gain or loss. So let's see. Revaluation gain or loss. First, get the revalued amount, which is the new value given to us, 30 million. So that will be 30,000. So less the carrying amount. Carrying amount at the date of revaluation. What is the carrying amount at the date of revaluation? So the carrying amount at the date of revaluation happened to be that of 56,500 less 14,125. So that's 42,375. So the current amount is 42,375. So therefore 42,375. We take it off. So this is revaluation was loss. There's a revaluation loss of less 30,000. 1, 2, 3. So 12,375. Accounting treatment. So here we only need 2 accounting treatments. Depreciation. Tell us how we should treat the depreciation, number 1. So how we should treat the depreciation, number 1. We should know how we will treat our depreciation. Very important. Then second, the accounting treatment. We are interested in these 2 items. In this particular question, only 2 items we are interested in. 1, how you will treat the year's depreciation. 2, how you treat the revaluation loss in connection with the 30,000. That's all. So you write up accounting treatment. So let's write something small. First, number 1, the depreciation. This one is a software, right? So the amortization, so here let's make it amortization, the software. The amortization must be first recorded in operating cost and subtract from where? The carrying amount of the asset. And that's what we did, and we had 42375. So that's the accounting treatment of the amortization. So the amortization, the treatment must be A, you have to add it towards the operating expenses. B, they have to subtract it from the carrying amount of the software. So subtract from where? Carrying amount. And that is what we've done here. But that's what we have done here. So we are done with the treatment of the amortization for the year in question. But why is it that we did not treat the 9,600 that we calculated? Why? Because that one is not a year in question. That was 2018, we are in 2019. So they have already done that. Then leverage item number 2. Item number 2 is how do you treat loss, particularly this guy. How do you treat the revaluation loss? Very important. So I want to take off the item 1. Can we get this section done? I'll take it off and bring the item 2 there. Good. Okay, so to continue the game, let's go to number 2. The accounting treatment number 2. That is for the revaluation loss. So number 2 is about the revaluation loss. How do you treat it? Please, we are interested in the calculation and then the treatment. But if you go and then the calculation is a bit tough, just perform the usual game, hunting for marks, by bringing the relevant issues or all the figures in it for us. Now, ideally, revaluation loss must be treated as an expense to the company for that particular year. So the revaluation loss will be treated as what? As an expense. However, so in an event where there was a previous gain, until that gain is cleared, we cannot record anything as loss because it's an exception. So the revaluation loss must be debited to the profit and loss or must be sent to the profit and loss unless what? There's what? A previous gain. Now, you have an asset. Last year, you made a gain of, let's say, 50. This year, the same asset is giving you a loss. You can't tell yourself that you made what? A total loss. At least offset it and know the difference. Good. So last year we made what? A gain of 18,100, which was sitting quietly in our OCI, other comprehensive income. So the gain was sitting quietly in our other comprehensive income, relaxing well. And then this year we've made a loss of 12,375. Now the issue is that until this gain is cleared, we cannot tell ourselves that we've made a loss. So because of this gain, wherever the gain is, let's set a portion of this loss to go and what? Offset it. Good. So all what we have to do is wherever this gain is. So first, this gain is in where? The OCI, right? That is it. So treatment number 1. Treatment number 1. Subtract the loss from the carrying amount of the assets. Subtract the loss from the carrying amount of the asset. That's the first treatment. And then, which will be recorded or recognized in the statement of the financial statement. Statement of the financial position. So this one goes to where? The financial position after the subtraction. The answer is it will give you the fair value at the end of the reporting period if you do the subtraction. So it's the same as you taking the fair value or the revalued amount at the end to the financial position. Because the current amount is 42,375. If I subtract the revaluation loss from it, it will still give me back what? The 30,000. So it's the same as you taking one bracket the 30,000. That's the fair value. Yeah, done. Then B, here because there's previous loss, and here even the loss is lesser than the previous gain, right? That means we can send all the loss to go and then reverse it. When did they recorded the OCI? Sorry, when did they recorded the gain? It was recorded in OCI. So that means go to OCI and then subtract it from there. So that is how we will treat it. So you go to OCI, to subtract from OCI. Subtract from where? OCI. Other comprehensive income. You subtract from the OCI. Other comprehensive income. So we are subtracting from the OCI other comprehensive income. Why? Because that gain was sitting in the OCI, which must be subtracted. And that's the end of the gain. So this will be the treatment that
was more than the gain.
in an event where this loss is more than the gain, that means assuming that this loss is around 20,000, we are just assuming that this loss is 20,000, then that means a portion of the loss must be released to wherever the gain is to offset it. So that means we can still offset all the gain and still there will be another loss. And still there will be what? Another loss. Because now the loss is for 20,000. So you can send 18,100 from this to the OCI, and the remaining one goes to where? The operating expenses, because losses must go to operating expenses unless there's what? Previous gain. So in that case, 18,100 go to OCI to reverse, and the remainder goes to where? Operating expenses. And you are done. Okay, so basically, that's how we will go through this. So let's see. Now we have to do the C and then the D. So give that one as a tryout. For the B, the D is basically the same as what we look at first. So we have to look at that one. So unfortunately for us, this is how far the good Lord will bring us. Great.